Morning, everyone. It's Wednesday, January 5th. It is 9:18 a.m. Eastern Time. You can see where we are here. This is the ES. We're in the middle of a developing balance area. And it's increasingly mature. This was the proverbial stopping price right about here. And then now you can see we're developing around this level. I'm not eager to buy this market, as I expressed yesterday. I still think that we could easily go higher. I would, frankly, what I'd love to see is this sudden another ramp higher for a day or so. But I do think that this market is probably in the topping process. Now, I'm going to be careful when I say that. I'm not calling a top here, but if we were to go up for another day or two, the breadth work that we keep is just getting to levels that are very extreme, and it's highly probable once those levels are reached that at least volatility comes into the market. Now we do have, it's January, we have all this institutional reset and allocation, all of those things come into play here, but I guess I'm just biased to the short side of this market from a swing, especially a swing trade perspective. Now, if we get up in here, you don't want to be fading necessarily, just blindly fading, but you want to be paying attention now over the next week or so to the shorter term key reference areas. This is a really important low, I think. If we get below basis the futures about 47.47, I'm paying attention. I probably want to be short, at least attempting shorts. Likewise, if we get up here, if we accelerate above this level, you don't want to be short, but I'll be looking for reversals up in here. And I'm also paying, as usual, close attention to all four of the indices because they're out of sync right now. And that will not last. They will move in the same direction when there is directional conviction among the institutions. So right now, I don't have a clue. It's a coin flip. If you go long, your stop has to be down here. If you go short, your stop has to be up here. So that's not a very good trade in any time frame. So especially as we're primarily day trading in here, there's no edge in here right now at the moment. Okay, guys, it's 10:14 a.m. Eastern time, and we've gone absolutely nowhere. Very narrow session range so far. You can see we're dead in the middle of the two most important pivots at the moment. Breadth is positive and is sloping higher. Breadth is sort of on a clock here, guys. I'm going to go to a 30-minute chart. You can see we haven't been below, haven't been negative breadth since the ramp began on the 20th of December. So this is just reflecting the incredible, extraordinary bid that continues underneath this market. That said, we're getting overdue for some sort of internal rotation contraction. I posted this annotation yesterday, this box, where at some point, sooner rather than later, you're going to get an excursion down into this level in breadth that may or may not be accompanied by very much price damage, but it's coming. It happens in all trends. This was an extraordinarily strong trend from the middle of October into, really this was the stopping price, into first week in November. But there were times in here where you would get breadth below briefly below or into negative territory, and then it would bounce back. Now, this particular trend so far has been even more bid than was this trend that began in the middle of October. I've always said trends and legs of trends will have certain personalities. So this trend is establishing itself as being this particular price breadth relationship within this trend is very strong. It's very bid. Part of the reason for that may be this early year allocation positioning among the indices. This is the very important short-term level, and that's the level that you see right here. So there's no edge in here at the moment. It's a coin flip. If I had to take a trade, I would be long against today's session low. And that that's a guess on my part. I'm not long and I don't have to take a trade. So okay, anyone that's trading this in here really is guessing. We're between levels of several degrees. It's just really clear. So be patient. So you can see here are the lows, here are the highs. It's just, there's nothing going on at the moment. There's no conviction in this market. It's random. Guys, it's 12:30 p.m. We're dead in the middle of a mind-numbing chop fest in the ES. In the meantime, the Dow is going straight up. The Russell is near today's session lows, as is the NASDAQ. So, as I keep saying, I don't trust things when the indices are this out of sync. I do think, again, this is early year reallocation. I guess we have the Fed thing at 2:30, so that could be add more nonsensical noise to the short-term trade. Just be very careful in here. If you don't trade today, it's no big deal. There's a trade tomorrow. Okay, guys, it's 1:47 p.m. Eastern time. I guess potential fireworks start at 2 with the Fed stuff. And sometimes that doesn't sell out until, really settle out until the next day. But we have the indices all over the place. We have the Russell near its lows, the Dow near its highs. The NQ, you can see where it is here. But, of course, the ES is somewhere in between. Stuff is all over the place. It's pretty random in here. I'm not chasing this thing to the upside. It would suit me fine if they spike it up another day or so. The higher it goes without any sort of normal retracement, the bigger the retracement will likely be that follows. So we'll see here. Breadth is finally negative. First time in several days it's been negative. So we'll see if this is front running or if it's just jockeying around. Again, it's an environment of randomness, and those are typically environments where you either want to avoid them or you trade very, very lightly. Okay, we're in about the 7th degree of noise within this range. Who knows? I swear, I wish I could be more help than I am right now. I'm sharing with you my thoughts. My strategy is to favor the short side of this market. This is noise. You could short it here, but if you do that, your stop has to be up here, just FYI. And quite frankly, if the trade works, it would be will have turned out to be a great reward to risk trade. But right now we're still in this area. You've got to get below about 47.50, and below 47.50, it could really get ugly to the downside. Okay, if you have a time frame of anything longer than intraday, this is a reasonable short here, right? Anywhere in here or between now and the close, you know, you're sort of playing games with how much lower is it going to go before you'd want to get short. And then the obvious level to put your stop is right here. Now let's go up in time frame and see what that looks like. There's a 240-minute chart. And here you go. This level is critically important. And as we all know, they'll play games around these levels. Sometimes they'll spike just below it and bungee jump back up. But if this holds, and I said this the other day, if this holds, it really opens up this entire range. Now, I'm not into the guessing game of where markets are going to go. I'm just saying it opens this up. There's nothing obvious over here that stops this from declining. I mean, you have these little tiny pockets of short-term balance that have formed on the way up, but this was an extraordinarily vertical structure. The other part of this, or another part, is breadth. Breadth is finally declined below, well, into negative territory. Now, that said, this is a decline that so far would be considered nothing but healthy in an upgoing trend. So there's your conundrum. So you have a choice there, and there's no right or wrong answer, and you don't know unless you take the trade. This is just trading reality, but this level is absolutely critical. And, you know, we're flirting with it now. Now, if we were to rip higher from here, I still think, based on what we've seen, based on the information at hand, I still think that we're in some sort of short-term topping process. Okay, it is 3:07. Today is a wonderful day in terms of providing a lesson into the realities of trading. And it's, you know, everybody wants this nice binary, buy here, sell here, put your stop here type of thing. And if the good news is that if you understand auction concepts, auction market principles of development, things like conviction, stuff we talk about in this room all the time, you realize that's not practical from a trading perspective. Now, you know, I mentioned over here that if you took the trade right here, it's no graceful entry, your initial stop would have to be here. And you really didn't know when you were here if this thing was going to just run this level like we've seen and bungee jump back up, or crater. Well, it's cratering. So those are the choices you have to make as a trader, and you need to understand in advance. So when you get to the point of making a decision, you know what you're going to do. But there is quite often, especially prior to big moves, especially when you're making a top or you're making a bottom, things can get messy. And then that's where you have to accept the uncertainty. You have to accept the risk of being a trader. Now, where we may go here, let me go out in time frame, back to the 240-minute view. Now, you know, where we stop in here is just a wag, a wild ass guess. Are we going to retrace all the way down to this level down here by tomorrow? It's not likely. I mean, we could. Is this likely at this point to just stop on a dime and rip higher? Not likely. No, it's not. A lot of conviction here. Now, breadth is having a healthy decline. So if breadth gets negative 2,000 or greater in the next between now and 4 o'clock, or tomorrow morning early, or in a couple of days, and that's where I would be looking for a low, and I would want to know where the market is at the time that occurs. I want to know how all the other three indices, the NQ, the Russell, and the Dow, how they are correlated at that level with wherever the ES is at the level if we get down to negative 2,000. And I'll also say this could, today's low, wherever that is, whether it's in place now or at 4 o'clock, could be the low prior to an attempt to rally to new all-time highs. That's part of the uncertainty of being a trader. Now, that you have to accept in being a trader. Now, you can, I always say, the default has to be the easy way. If you're just confused, frustrated, you don't know what to do, go to a 3-minute chart. If the market is making lower lows and lower highs, you're selling. If it's making higher highs and higher lows, you're buying. Sometimes even on the short-term charts, it's not, the pivots are not these nice, neat things. And this is an example of that. Had all this noise up here, and then the market shot down. And then you had a little bit of a retracement, then you had the lower low. Then you had a little bit of a retracement, you had the lower low. So it's clear, especially when you broke below, and I talked about this level, I've been talking about it for a couple of days, this 47.50 level. So you had to be aware that that level was important. But so far, we're making lower lows and lower highs since we broke that level. You don't just rote trade a level. You don't just rote trade necessarily a pattern, but you use those things synergistically in a strategic and a tactical plan. Okay, let's look at a bigger picture here. Let's look at our breadth stuff, okay? Now, I've been talking about this 10-day moving average, and this is as extreme as it has been. I think 2 other times we got to this extreme since the March 2020 low. Now, over here, I was talking about the 5-day moving average. Not only 5, but 3 and 4 were at extremes that we haven't seen since right off that March 2020 low. And then, of course, we've had this lingering divergence in breadth since this kickoff on the 21st. And in typical fashion, we went a lot higher on a lot less breadth, the higher highs and in breadth were in price, and then lower lows in breadth. And then this was a pretty extreme divergence yesterday. I think I pointed that out yesterday at the close. You can go back and review the live room recording from yesterday. Now, breadth is as extreme as it has been almost since the December 2020 low. On the December 2020 low, it did not close below negative 2,000, but it was negative 2,000 most of the day, if you recall. And it wasn't until the last 10 minutes or so of the day that you had this sudden expansion in breadth that closed it above the negative 2,000 level. But this has been a solid harbinger of an impending rally since the March 2020 low. Now, it's not causative, but it's perfectly correlated, quote unquote, so far. So are we going to trade all the way down and through this level? It's unlikely that we would trade all the way down and through this level. Now, it's unlikely we'll trade directly to it, and more unlikely we would trade directly to it and through it. If we did that, you're talking about some sort of a waterfall decline like we saw in March of 2020. I don't think that's likely. But I do think that it's reasonable and I have said this several times along this ramp higher, for this market to come down somewhere in here, and then maybe breadth gets very negative, maybe breadth reaches negative 2000 and it's in here somewhere. And then that could set up, is likely to set up a rally attempt. So that's sort of what I'd be looking for this week. Let's see if we get some hard selling, some follow through for the remainder of the day, maybe into tomorrow, and then maybe there's a short-term low by, what's the day? Today is Wednesday, by Friday. Okay, Meyer, are you there? All right, I want to show something here. Okay, you say, you make the comment, I'm looking at November and December market profile. It's obvious that 4675 area was the HVN. It could be the target of this drop. All right, let's explore that. So this is December, this is November. If we combine them into the one auction that they are, then you're looking, here's your HVN right here of that structure. Okay, 4691, 4670. So, okay, so that pretty much fits with what you say. But, and this is a big but, let's see if there isn't additional information. So if we split this out, and I've said this before, this is conviction, okay, to the upside. It's wide range conviction. This effectively erases what came before it. There's only one party in the market that can create a move like this, and it's the big money. It's the dealers. It's, you know, it's a whoever it is that's large enough to make the market one-sided and to run over the other side. So when something like this is created, it sets up all of this conviction in this elevator shaft in here. Now, could the market stop here? Yeah, it could. You know, as a matter of fact, if you look in my report over the weekend, I sort of labeled this as a potential place that the market could stop, but not because it's close to the high volume node, more because it's roughly midway this range and in strong trends and strong vertical trends, whether you're looking on a 1 minute chart, 5 minute chart, 30-minute chart, you name it, 240, this would effectively be a daily chart. In strong trends, you typically don't want to see conviction in the time frame you're analyzing or trading retrace more than 50% of that conviction. So that's why I roughly chose this level. Plus there's a gap in here from a day session. So, you know, not that gaps are anything special, but again, this reflected a lot of conviction and acceleration to the upside. So it's not about, to me, it's your point is, I understand that, but to me, that's not, if it stops here, it's not causative, it's correlation. And I think we're better served, we have the benefit of following, you know, the breadth, especially in declines in the stock indices that we don't have in other markets. So, you know, that's one of my big bugaboos, problems with the market profile traders of the day. They've sort of hijacked market profile from what it was intended to be, which was a tool to identify market condition, and they've turned it into magic, or tried to. Okay, I talked yesterday about how unusual it was for breadth to stay above zero as long as it has. And all of a sudden we get the big release today, and now we are negative 2000. This is important. Now, we can't draw any hard and fast conclusions, but in keeping with consistency, every single time since the March 2020 low, we've had a negative 2000 breadth reading it has marked a momentum low in the market. Now, understand I just said momentum, not price low. So we could go considerably lower, but what this should mark, if it's not different this time, is another swing low in the bull market. Now, it can take a week or so for the final bottom to form. There could be some back and forth and et cetera. But with, even as far as a price low is concerned, I'd be surprised if we don't see a price low now by, I don't know, Friday. If they kill it tomorrow again, that'd be a little unusual because that would be 2 consecutive days with negative 2,000 breadth. But it still would fit the parameters of how the corrections have played out in this bull market, or the bull leg off the March 2020 low. I am of a mind that this is a continuation of the bull market off the March 2009 lows, and that the February-March thing in 2020 was just a violent reaction within a larger degree bull trend. But that's semantics. It really doesn't matter. But since the March 2020 low, the pattern has been when we reach negative 2,000 breadth, you've been close to a momentum low. So this is setting up to be a fun, illuminating week. Okay, guys, it's 4 p.m. The cash market has closed. Now, if you're taking multiple positions overnight, I would consider taking something off right now. It's negative 2,000 breadth. It's just good practice. When you get this compressed, even in bear trends, you're likely near a momentum low. Now, I would not take my entire position off here, even if we get a big bounce tonight and into tomorrow, because it's also more likely than not that we make lower lows. And there's also, I'll throw this out, the possibility that they crush this thing again tomorrow. So let's just take a look at market structure. Let's look at the bar charts. Let's look at the profile perspective, and we'll take a look at the technical perspective. So I'm going to start with the cash indices. And I've been talking about the disparate activity among the indices at the all-time highs. The Russell could not get above this level. This was clearly an important level. Now, the annotations you see on my screen are from the report this past weekend. You can go back and see it. So we're cratering into a level here in the ES that I had identified as a potential retracement level. And there's nothing between where we are now in this low that's objective. I don't do the magic number thing, fibs and all this other nonsense. If fibs worked, everything would be lined up and everything would stop at some fib retracement. Now, that said, they almost have to stop at some fib retracement or extension or some magic line because there's so many. Anyway, enough of that rant. You've heard it before. The Russell has sliced through the level that I had sort of postulated as a potential quote unquote support level, a key reference area. The Dow is holding up really, really well. It has not even taken out the low of the third, so it's holding up extremely well. There is still considerable distance to go to get to this low down here that I think is really important. And let's see, if we were to, that's another 4% down. It's unlikely that you see that in one day, okay? Very unlikely. It can happen, but it's unlikely. Now, we're not that far in the NDX. We're certainly not that far in the Russell. We're a long way away in the Dow. Now, on the bullish side of the ledger, I would point out that the Dow is holding up so well. It has not taken out its January 3rd low. Typically, when you have these extreme moves up or down, everything will be in the same structural position. We're not there now. And that was sort of the heads up at the top. And it's why I've been so uncomfortable. And it's also why I've been adamant about, personally, I was not going to chase this market higher, even if it went higher. So what I would look for, what we typically see now, and I'll check it in just a minute. What we typically see now is a momentum low in the market. That doesn't mean it's a price low. Typically, it's a momentum low. Now, it's a little bit rare, but it does happen on occasion to see back-to-back consecutive wide range down days and days where you have negative 2,000 breath back-to-back. That's pretty rare. If that happens tomorrow, it's almost certainly extremely near a price and a momentum low, if not the price and momentum low. But again, I don't want to get too far ahead in the guessing game. So let's take a look at the profile view of this market. And here we are. Now this, I explained this earlier today in a discussion. Yeah, it's coming into a high volume node, but that's a big so what, because this is conviction and effectively it erased what came before it. And I explained why. So, you know, you have this big distribution range. Let me do this. Now let me do this. You have this big distribution range. So there's an auction range that began, I think what's this, December 20 low into yesterday's high. And we'll see how much of this auction range is explored. And that we're in that exploration process now. There is no edict about how this thing has to form from here, what shape it's likely to take, where it's likely to stop. That's nonsensical stuff. Okay, let's take a look at the Dow, since it's right here. And it's been by far the strongest of the indices, but it, from a structural perspective, is similar to the ES in that this is a distribution range. So this is potentially an auction extreme low. This is potentially an auction extreme high. We'll see how much gets explored. It's also possible that this is going to be a balance area that forms. Same thing for the S&P. That top, the top we just saw, and whatever low we put in, if we put one in the next day or two, could be a low of a balance area between that low and today's high. And looking at, let's go to the NDX. And here's the NDX. Now the NDX is different. It has been displaying relative weakness, which is really interesting because it has led the bull market. All aspects of it, regardless of how you want to define the bull market. It's been the leader. And so this is a low extreme, this is an upper extreme, and it looks like we want to go down and test this low. Okay, the Russell, the enigma that is the Russell. Here we go. And I'm gonna split this out. And, you know, back to the upside here, really probably shouldn't retrace this much. And this level down here is in play. Okay, let's look at the technical perspective. Okay, now this is an area, a broad area where if we're not in, you know, unless we're going to have a waterfall decline similar to March of 2020, this thing is likely to find at least a short-term low in here. Breadth is going out at negative 2,000, almost negative 2,100. So we're on a watch here. We're on a this could very well be a momentum low. Now we're on a price low watch. This is going to be important. This level right here is critical, 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 critical. At this point, I don't think we'll get down to this level. If we were to get down to this level in the next week or so, it would just be very important. Let's put it that way. So guys, we're off to a fun week in this first week in January. I'll see you in the morning. Have a good evening.